The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis, and I'm here with Graham Witcomb and Angus Donohoo for today's podcast, where we will be covering capitalising R&D expenses, GPUs as collateral, and also Domino's Pizza. But we're going to kick off with a number. And now the number is 2. And what I would like you two to do is guess what it applies to. This is a mad number, and it give you a clue. It does not relate to the number of marriages I've had.
Gee. The number 2.
That's a pretty broad.
You're never going to guess it. I'm going to tell you. 2 is the number of noses a human face possesses.
Okay, you'll have to explain that.
Yeah,
one.
I didn't see that coming.
No. It was a professor in South Wales has made this argument that we see the nose because it is a unit on our face, but it's no different to our eyes or ears because the 2 nostrils that we have are completely independent systems. They're 2 different channels with 2 different ducts, and they operate independently of each other. So they are much more like our eyes and ears. But because we see the nose with 2 nostrils in it, we only see it as one system rather than 2.
Do they become one when people get a ring through the middle? And then
Maybe. I don't know. Anyway, let's kick things off. I'll make a confession. I have never owned Domino's Pizza, and I've never eaten a Domino's Pizza.
Really?
Missing out.
No, I know, it's incredible, isn't it? My eldest son, has made more than made up for my lack of contributions to Domino's bottom line. But this week we had some news. The CEO, after, I don't know how is it, 18 years?
yeah, more than 20 years.
More
in
than
the top
20
job,
years
but he's been
there.
with the company for 40. So
Yeah,
it's a long-term
incredible amount of time. I do remember a story from 20 years ago when Wayne Jones used to write for us. He runs Gains Capital, and he's in Brisbane, and he remembers being in a Brisbane Domino's and saw Don answering the phone when they had 1-800 numbers rather than the internet. He thought that's what a good CEO looks like. He's out there in the stores answering the phone. How big a loss is this to Domino's, do you think?
Well, I think it's quite a loss. He did a great job over the past 10 years. Over the past 20 years while he was in charge. The company basically increased its store count by a factor of 10, and it's far bigger and more profitable now. Shareholders have done great out of it, but the last few years, Domino's has kind of slipped a little bit.
Why is that, Graham?
Well, a lot of it was people debate, but a lot of it has come down to the Australian strategy just didn't replicate very well in Japan and in other parts of Asia. And so I think there was a lot of hype around the Japanese business when it was first kind of taken on. And then since then it's been struggling, and basically Don has taken most of the heat for that over the past few years. And I think just, rubbed the wrong way with some of the other board members, and eventually just kind of got shown the exit a little bit.
Didn't he officially retire? He wasn't officially pushed. He retired, right? But this is one of those behind closed doors agreements where everybody saves face.
Yeah, I think so.
Fair enough.
It's a convenient retirement after a string of poor performance, and then you have troubles with the chairman. So, but anyway, he's retired, but I think he did a great job, and it would have been nice if he was given a bit more time. I think he was learning from the mistakes that were made, and I don't know, sometimes just changing it up to a new CEO, they can just make new and other interesting mistakes rather than correct the ones that were previously made. So, yeah, I would have liked to see him. I think it is a loss for the company, but we'll see. The new CEO, Mark van Dijk, he seems to have a strong background, so maybe he'll be able to turn around the Japanese business or make some other decisions which go in Domino's favour.
Okay, Angus, what's your feelings about Domino's?
I mean, my knowledge of the company is probably inversely proportional to how much pizza I eat.
Well, that's not a bad place to start.
I don't know a lot about the company. I did see that the CEO had retired. I was quite sort of struck by just how popular and how dominant the share has been in Australia. You know, people who bought that early did extremely well out of it, especially, I mean, it's come right back from where it did reach, but it's had extraordinary performance. When, you know, pizza is such a kind of fractured landscape, I would say. I mean, I guess I live in Sydney, but there are pizza places in any direction, you know, within 500 meters of me. I could get a pizza from a different little shop, but Domino's really managed to corner a sort of a big slice of the market.
Oh dear. Oh dear, yeah, Angus. You really let us all down there. And you stole my only remaining joke. But that is an interesting subject, because Domino's, I think, was the first to adopt this kind of concentrated strategy. So the theory was previously with retail outlets that you don't want to cannibalize your existing stores' sales by putting stores too close together. Domino's kind of did the opposite, didn't they, Graham? They called it this fortressing strategy, and the idea was to squeeze out all the available competition in those areas. Do you think that's worked?
Well, I don't think there's any doubt that it's worked in Australia. Yeah, I think that they do improve their delivery times, their service ability. They push out other competitors, so it does. It has worked here. I think that's a big part of its success locally. Yeah. And I suspect it's actually worked in Japan as well. That it's mainly it's not so much that strategy that didn't work, but the Japanese culture just didn't quite fit with Domino's product offering.
Yeah.
There's a lot of competition for good food there. So
it really is. It's a very difficult market. You know, I don't know what percentage of the population are lactose intolerant to, but when selling a product made of cheese, it probably makes it a bit harder.
Yeah.
Let's talk about the share price, because when I look at it and the recommendations we've made over the years on it, back in, I think, mid-2019, I think we upgraded Domino's and put it on the buy list at $35. And then it must have been, Graham, that one of the mother of all COVID stocks, it reached an incredible high that was up over $160, I think.
Yeah.
Where are we now? We're back where we started, really, aren't we?
Yeah, well, that's part of why Don Majors left. But I think that run-up wasn't a true reflection of the value in the company. It was just a lot of hype, like a lot of COVID stocks. People were at home, they were eating more. I think, it got swept up with the mania. But you can say that the company has lost some value since then, maybe, but I wouldn't think that it's been catastrophic.
No. And would you say, I mean, I know that you've ascribed a sort of business risk rating of high, and same with the share price risk rating, even at around $30. Would you say a large part of that is to do with the fact that Meiji is leaving?
Well, that's, I think, why the stock has fallen over the past week or so. But in terms of whether that's really going to be a long-term impact, I don't know. He'd been there with the company for a long time, and maybe an eventual exit had already been kind of factored in. It's always hard to predict what the price is reflecting in terms of the risks. So, yeah, I think that at the current share price, it's probably around fair value and, well, actually under fair value, but we're not quite at the point where we'd want to upgrade it yet. There are still some important risks that we need to consider, and they haven't turned around the Japanese business, which is a big drag. Same-store sales have kind of slowed significantly. They had a big issue with pricing recently and the kind of inflationary pressures. So it's not as if it's risk-free, and the current share price, I think, is below where it should be, but it's not quite the best opportunity out there.
Yeah, I agree. It's we've got it as a buy below $26. So let's hope it gets a bit closer to that price. It seems to be moving in that direction recently, but we'll see where that goes. But let's move along now to a story that I find really fascinating, Angus. I've often wondered, if I was to run a software business that wasn't going that well, what would be the best way of presenting my profitability without breaking any laws, but really wasn't really profitable, didn't disclose the true profitability of the business. And I think your answer to that would be to capitalize R&D expenses. Would that be right?
That's certainly an effective way to do it. There's all sorts of ways you can kind of juice the books, but I think that that's a pretty good way of doing it. So what you're doing is on your income statement, usually you have things like research and development costs. So they come in under in your operating expenses.
And can you just explain exactly what research development costs are and why they're separate to other kinds of costs?
Well, there's where it gets really tricky because it is a fairly nebulous idea. Essentially, it's where a company is trying to spend money to get ready for the next thing that they're moving to. So essentially that they're expanding their revenue generation capability. So that they're, so if it's a biopharmaceutical company, it's doing that research. It's kind of an easier idea to understand. But with a software development company, it's quite tricky to actually think about how do you separate the parts of the business that are assets that are going to be generating more and more future value, and what are expenses, are just costs of doing business.
Right. So let's just go through that, because I think this is important for people to understand, because the nature of the cost is the key here. If you're a pharmaceutical company and you are developing a new drug, that is clearly a research expense, right? An R&D expense. If you're Boeing and you're developing a new aircraft, that's true too. But if you sell a software product and you add a new feature to an existing product, is that R&D or not?
I think generally it's not. I would sort of say, especially given, frankly, one of the things that's critical to think about here is when you capitalize an asset, you still pay it off, but you reduce, you stretch out the time in which you're paying it off. So you buy it in that first year, but then over the next 5 years, you pay it off incrementally. So then that comes back into the income statement as depreciation. Where it gets tricky with software.
So it would be like buying a piece of machinery or something like that.
Yeah, or a car that you pay off over 10 years, something like that. Where it gets really tricky with software, though, is that the development cycles of software are now normally, a lot of, especially a subscription software company, they're putting out developments every month. They're putting up updates every month on that product. Yeah. So distributing that cost over the subsequent 4 or 5 years, I think it's a bit dubious. And so
when you say the cost, you mean the costs of the staff who are doing that development?
Well, and that's another thing, right? So if you're spending your R&D budget, or you're capitalizing you're buying an R&D asset that's a machine that you're going to keep using in future years. That makes a bit more sense as something that is going to generate more revenue going forwards. But some companies, and one that I've been looking at recently, it's capitalizing a huge amount of its software development costs. So it's salaries for its staff, it's staff salaries, it's capitalizing that and saying that it's an asset that can pay off over a long time. And I think it's doing that to boost the apparent profitability of the company.
Okay, so the company is SiteMinder, which is probably classed with a lot of the other Australian tech stocks. Can you tell us what SiteMinder does?
Yeah, so they developed software for hotel businesses. So if I owned a hotel and I needed to manage all of the bookings, and now it gets quite complicated because people might be booking through Expedia, or they're booking through booking.com, different websites that they're using to book, or maybe they're even phoning up on the telephone. So you've got to kind of manage where your bookings are coming from. You've got to collect the money. That might be in all sorts of different currencies. And then you've got to, do the invoicing. And SiteMinder even do things like they'll build you a they sort of have a website development kit kind of built into it. So they're a platform business sort of. So they have a variety of different software products that they sell in a subscription. And that's where sort of most of their revenue comes from. And then they also do transaction costs. And they're founded in Australia, and they're doing about $190 million a year in revenue.
Okay. And after you looked at the company, you said for the past 4 years, the company has capitalized more than 200% of its R&D budget.
Yeah. So in each year, so they're spending something like, they're expensing something like $12 million in R&D per year, and then they're capitalizing about $24 million of it.
How do they capitalize more than they spend, though?
That's what I'm wondering.
Yeah. So I mean, basically, they're spending 36 million in R&D, and they're capitalizing 2/3 of it, and expensing 1/3 of it.
Yeah. Okay.
So it's completely legal, and it's something that the accountants. There's a lot of debates. So it used to be GAAP accounting, which is the one that's more used in America. That used to only be that you had to expense R&D costs. You always had to expense it. But as with all of these things, it's with accounting, it's often not really a clear picture. And I'm not an accountant; I should qualify. But it's not always a clear picture. And so there's kind of arguments for and against. And I think to go back to your original point about how would I conceal losses. This is one way, and you can see that this can be used to conceal losses, but you can also kind of see the counterfactual, which is something Graham previously wrote about. What was the business that was doing kind of the opposite? It wasn't really showing its profitability because it was capitalizing too much.
Probably Gentrack.
I think it was Gentrack, yeah.
Yeah, Gentrack's an interesting one. That's where you can kind of see a difference because in how they account for it, because it's got a close competitor, which is Hansen. Gentrack expenses everything, all of its R&D, whereas Hansen only expenses part of it and the other part it doesn't. So if you're looking at their profits, you can't really compare them equally because there's a really different free cash flow situation kind of behind the scenes. So that's a good example where I think I think a way to get around the differences in accounting around R&D is to look at the free cash flow for companies. That gives a much clearer picture of what cash is going in the door, what cash is going out the door. Profit and loss statements are just too easily manipulated, particularly with all of the R&D expense differences that software companies can use.
But I guess then with that amortization, right? So then in your cash flow, you can put that back in and sort of, because it's not a cash loss, right? So it does kind of make the whole thing just becomes very, very murky, I think.
Under what circumstances could you justify this kind of approach, do you think, from a valuation perspective or from for an ability to see through the accounts and see what's really going on?
I think with research and development costs being capitalized definitely makes sense in some things, such as in pharmaceutical companies and probably even in some tech companies as well. But it really comes down to the certainty of that future benefit. I think there's a big difference between, say, CSL developing a drug. It's already been approved and they know this drug is going to make bazillions. That's obviously an asset. That's not an expense.
Right.
Whereas for a tech company that has built some new feature that hasn't even been tested in the market, then that I think is a much more murky asset than what CSL is producing. But I think there's a place for both. I think there is a real difference between expenses and assets, and sometimes assets look like expenses. But yeah, it does just get very blurry, and you've got to look at each case one by one for it. Yeah.
Angus, I think it's sort of a question of proportionality too. So some of the sort of the reading around this that I was doing, there was, commentary of, well, if you're capitalizing 20% of your R&D budget, then that's kind of acceptable. But then if you're, capitalizing 66% and you're a software business, that gets a lot murkier, I think.
It's a good idea to compare them with other competitors, because it'll stand out. If all of the industry is doing one thing and you see one company kind of really out on a limb in how it's accounting, then you've got to ask why it's doing something different.
Which is what we saw with lifestyle communities, right, Angus?
Yeah.
Same thing. That comparison showed an outlier.
Yeah, exactly. It was when we compared that. What was the term that they used? The value of the way that they were valuing their assets and adding that value, that additional value back into their income statement was so much greater than all of their competitors.
Yeah.
Fair value adjustments. That's
fair
what
value,
it was.
That's right,
Their fair value adjustments.
I love that. Depending on whose idea of fair it is. Okay, there are other problems with this business too, as well, by the looks of it, Angus. Another favourite technique of tech companies is to hang on to their favourite employees by giving them lots of free stock or almost free stock. SiteMinder is doing a bit of this as well.
Yeah, and the dilution has been very, very significant. So you've had the share count more than double in just a couple of years. So yeah, there's the stock-based comp. I mean, it's kind of a classic tech story, but even that, the way that the adjusted earnings are constantly used, and I'm seeing it a lot in Australian prospectuses, particularly where management are really getting away with saying they're cherry picking their own version of what profitability is.
Yeah.
And I think that's fine. That can be okay, because sometimes it probably is giving you a clearer picture of how the business is operating. But I think sometimes it is also just being used to make everything look a bit healthier than it is. And it's a really complex, nuanced thing to understand what is actually different about what's being claimed and what isn't. And so I think, there's a pretty strong argument for trying to cut that sort of stuff out altogether, because I think it can really confuse people and possibly can deceive them, I think.
Yeah. Okay. And when you've done a comparison with other products as well, and SiteMinder doesn't come out too great against its competitors too. But one of the astonishing things I found with this piece of research was the valuation comparison. So you can't do a PER on SiteMinder because it's not really profitable. But when you look at price to sales, SiteMinder is at 9.4, Booking.com is at 7.4, Expedia is 1.9, and Airbnb is 8. How is it that SiteMinder can get a price to sales ratio that's greater than Airbnb and Expedia and Booking.com and TripAdvisor when it's not making any money and isn't growing very quickly?
Yeah, I mean, I think it's a deep question, and it's something that I'm sort of seeing in quite a few of the Australian technology businesses. And my own pet theory, and I don't. This needs to be worked through a bit more, but it does seem as though Australian technology businesses are getting these incredibly high valuations, and I suspect it's connected to the fact that there's so many of the large superannuation funds have investment mandates into the Australian share market. So they have to be putting a certain amount of capital into the Australian share market. There's only a few technology stocks for them to pick from. And I think that might be at least a factor in driving these huge valuations that you're seeing. I mean, Airbnb is actually a younger company than SiteMinder. It's
growing more quickly.
far larger, but it on most metrics, or pretty much on all kind of valuation metrics, it looks cheaper. And yet Airbnb is generally not considered to be a cheap stock by any stretch. It's on sort of a 30 PE. Why is it that an Australian company is trading on a lot of these Australian tech companies are just trading on such, I would say, crazy trading multiples? And I think there's a distortion occurring in the market.
What do you reckon to that argument, Graham?
Well, I don't know. I don't fully buy into the idea of the superannuation having that big an effect, just because once they've actually invested the capital, it's just sitting there. It's not like they're constantly trading and so driving up the price that way. Once they buy a stock, it just sits in their treasury and is inactive. You've kind of taken that stock out of the market. So yeah, I'm not sure that pressure would be enduring enough, but it might be, I guess.
Yeah, I mean, I'm not sure either, to be honest. But I mean, I guess that sort of anchors the price on some level, though, right?
Yeah.
When you've got a really large shareholder buying it at a certain price and then not selling. Anyone else who wants to come in has to pay more. So I don't know, but it is just interesting. We looked at Xero recently, and Xero similarly is at a significant premium to its, to kind of its comparable. To comparable businesses. And you're seeing it with SiteMinder. And, it has been growing nicely the past few years, but over the last 5 years, it's grown at sort of an average of 20%. And even when going from the COVID, what should have been, I guess, the COVID lows for a travel agency sort of business or a travel software business, it only grew 30%. For a growth stock, that's pretty, modest growth. It's not bad by any stretch, but does that warrant a 10 times sales valuation? And I find it difficult to reconcile.
Yeah, me too. Okay, let's move along from no profit, high multiple businesses that are even more expensive than ones in Silicon Valley, to something that kind of is related, I suppose, in some ways. It turns out that there's a new debt market, Angus, in GPUs. What's going on there?
This is quite an extraordinary story. So the Financial Times has kind of have been spearheading the investigations into this. So there's these businesses that are called neo-cloud businesses, which is a nice term. So a lot of the neo-cloud businesses started out as cryptocurrency mines. So they were stockpiling GPUs, which are the main hardware pieces for doing AI research, are also very useful because they do all this parallel computing. Very useful for mining cryptocurrency, mining Bitcoin. Yeah. And so these businesses that had all of this Bitcoin mining inventory started loaning out those GPUs to your cloud providers, your data centers, to allow them to do AI workloads. These companies, NVIDIA, which is the main GPU manufacturer, has invested in at least two of the major neo-cloud companies. These neo-cloud companies are also now some of the largest customers to NVIDIA. So NVIDIA has invested in its own customers, which is the sort of circularity that you always want to be very cautious with when you see it. And then it gets more convoluted because to sort of fuel further growth, these neo-cloud companies have been borrowing billions and billions of dollars to buy more GPUs. So now you've got this debt market of people financing these companies to buy more GPUs, which are the customer and the
these aren't small numbers either, right? There's believed to be over 10 billion in loans to these neo cloud companies.
Yeah,
so
CoreWeave,
by BlackRock and PIMCO and people like that. So it's kind of like a triple play.
Yeah,
it's kind of a triple play. You know, you're betting on NVIDIA's stock, you're betting on NVIDIA's investments, and you're betting on those investments coming through and the loans being able to be repaid.
Yeah, I like that. It's a triple play. To sort of put some numbers to it. So, like CoreWeave, in 18 months, its valuation's gone from $2 billion to $18 billion, and it raised $10 billion in debt from Blackstone and Carlyle. And so they supposedly got a contract with Microsoft worth $1 billion. So then they went out and got debt financing to buy another $2 billion worth of GPUs. Macquarie Bank's gotten involved in it, so there's a nice Australian connection.
Good. Yeah.
It sounds. It's a sort of thing that happens at the top of markets, I think, rather than at the bottom. It is.
Yeah, it does. It does feel like that. What do you think, Grant? Does this look a little bit odd to you?
I think it must be just so fun working at NVIDIA at the moment where customers are scrambling over themselves to buy what you've got. Just such lunacy in that demand.
I know.
It sounds really, really crazy, the whole... Well, I'm very curious about the NVIDIA investing in these businesses because it sounds like NVIDIA is the one who's just sold you the product and now it's wanting to buy them back from you through a stock purchase. So I find that bit kind of strange. The lending to buy doesn't surprise me too much. And if the bankers want to lend out that money, they're the ones on the hook if it doesn't get paid back because the company can't actually make anything out of the new GPUs. So that's on the bankers. But the rest of it, the NVIDIA's involvement with its customers is kind of odd.
It is. What do you make of this, Angus? Because what are the things that might bring this whole thing apart?
I think where things will really start to unravel is if at the moment there's been this relationship where the more money spent on GPUs, the more powerful the models. So essentially it's just been this question of scale. So companies have been rewarded by that they get material improvements in the performance of the models by just throwing more and more GPUs at the problem. If that relationship really starts to break down, and there's evidence in some places that it might have,
really?
So you're just not getting that dramatic outperformance. The other places is there's still not proven products for this. The demand for, there's these hyperscalers, that these large companies like Microsoft and Amazon buying lots and lots of these things, but there isn't necessarily the products that people are using in their day-to-day lives that are actually fueling that demand. A lot of that demand is being driven by speculation and not just financial speculation, but by speculation about what the sorts of products and what the sort of demand for those products is going to be. And I think a third thing that could undo it a bit is NVIDIA it's really for the last few years, it's been out on its own. It created this moat using software, it's sort of software libraries. You've got the hyperscalers themselves. So companies like Amazon, companies like Google are building their own GPU alternatives. And so you're starting to see competition fill in. And generally, semiconductors are always very cyclical. So at some point, the cycle's going to turn and, it could get ugly, I think.
Yeah, it could evaporate so quickly when demand is being fueled by debt rather than cash flow, because then all it would take is the bankers to suddenly get a bit fearful that the market isn't what they expected and to pull the plug on that lending, and then suddenly NVIDIA's sales would just plummet.
Yeah, that's right. That's right. It does look like one almighty gold rush to me.
Yeah. And you can't tell whether NVIDIA is the gold or the guy selling shovels.
Yeah, that's right. That's exactly right.
That's really good. Okay, I think on that note, which could not be better, Graham, that was perfectly summarized, we are going to end it here. Angus, thanks a lot for coming along and chatting about SiteMinder and the weird world of GPUs. And Graham, thank you too.
Thank you so much.
Thanks, John.